I mean, you think about the options, and I'll sort of boil it down to like three options. There's a lot of idiosyncrasies in between and meta decisions in there, but to me, there's like three big macro choices, right? You can create a portfolio of high dividend stocks for yield, right? As opposed to going into fixed income, you go into and you get your yield from dividends. Well, if you've done that in 2020, you would have suffered mightily, and in a way that you haven't in the past when the S&P, which declined 35% from February 19th to March 23rd, dividend stocks have fared worse, right? So just because of the sectors and the way that they're comprised and the industries that they're in. Okay, so number two would be stay as conservative as you are and just accept the fact that you're going to have lower yield, right? Which is, I believe in your question, you talked about clipping coupons, right? There's that. Same amount of risk, maybe, but for less total return in the end, and certainly less income. And the third is you increase your risk in the search for additional yield. And then once you step into that paradigm, it's, well, how far do I go and for what risk and what yield? I mean, if you look at inside of that vector, you've got, A-rated bonds right now that are yielding just over 1%. You've got BBB bonds that are like investment grade corporate bonds yielding just over 2%. You've got leverage loans, which are below investment grade loans, but they're secured and senior secured in the capital structure. They're at 4%, and high yield bonds below investment grade corporate bonds are at 4.5. Okay, so if you wade into those waters, you're incrementally increasing your risk, maybe exponentially, to reach for additional yield. Then you've got hybrid securities like convertible bonds or preferreds. I mean, if you just randomly pick a preferred stock, ETF or index, you're looking at between 4 and 5% yield right now, which, look, based on historical precedent in treasuries, that's not bad. But when you think about the principal risk, right, your price risk and what your total return could yield because of the additional risk, many of these preferred stock ETFs or mutual funds fell more than the S&P in the Corona crash. So this embedded equity beta or embedded equity risk tends to show up when you least want it to, right? And I think it's the compilation of these risks that investors really have to be aware of and understand, they may be trading short-term security for the hope of higher long-term capital appreciation. One last thing here is, I think the big question is, how much volatility and risk are you willing to take? What are your goals? And our data suggests that the more you move down the risk curve, the more equity beta-like risk shows up. And this is really a double-edged sword of both higher expected returns, but potentially significantly higher risk. And I just think that's based on the preference and maybe the behavioral emotional makeup of the investor, but they need to know exactly what they're getting when they choose to wade into one of those three options.